Okay, I declare open this public hearing of the Parliamentary Joint Committee on Corporations and Financial Services. Today the committee is taking evidence as part of the inquiry into the impairment of customer loans. It's a public hearing and a Hansard transcript is being made. The committee prefers to hear evidence in public. We may agree to take evidence confidentially if it's relevant, and the committee may publish confidential evidence later, but we would seek to consult before doing that. It's important that witnesses give the committee notice if they wish to give evidence in private. In addition, if the committee has reason to believe that certain evidence may reflect badly on a person, then the committee may direct that the evidence be heard in private. I remind all witnesses in giving evidence to the committee that they are protected by parliamentary privilege. It's against the law for anyone to threaten or disadvantage a witness because of evidence given to a committee. If they did, the action may be treated by the Senate as a contempt. It's also a contempt to give false or misleading evidence to the committee. Witnesses should be aware that if they make adverse comment about another individual or organisation, that individual or organisation will be made aware of the comment and given reasonable opportunity to respond. If a witness objects to answering a question, the witness should state the grounds of the objection and the committee will determine whether it will insist on an answer. Sydney, the committee welcomes officers from the Commonwealth Bank. Thank you for attending today's hearing. For the Hansard record, could you please state your names and the capacities in which you appear?
Certainly. My name is David Cohen and I'm the Group Executive for Corporate Affairs and Group General Counsel of Commonwealth Bank.
And my name is David Craig. I'm the Group Executive for Financial Services and the Chief Financial Officer of the Commonwealth Bank.
Thank you. The committee has received your submission, which we've numbered submission number 48, as well as some additional documents which we've just agreed to receive and publish today. Would you like to make a short opening statement before the committee proceeds to questions?
Yes, I would. Thank you for the opportunity to appear before the committee this evening. I've been the Chief Financial Officer of the Commonwealth Bank for over 9 years and was closely involved with the acquisition of Bankwest. With your indulgence, I think it would be helpful if we take about 10 minutes to revisit some of the history of the purchase of Bankwest, talk about some of the testimony that the committee's heard, and particularly to address some policy ideas which we believe will support lending to small businesses in the future. Banks play a critical role in financing commercial businesses in Australia. According to the Reserve Bank, 99.5% of all businesses are successful, so their commercial loans are advanced and repaid without difficulty. Unfortunately, not every business is viable through the business cycle. Of those that go into default, commonly the customer and their bank work together to either restore the loan or to find other mutually agreeable solutions. If a business does default on its loan, it is understandably traumatic for those involved. We have listened to witnesses who have appeared before the committee and who have told stories of financial distress, impacts on their relationships, depression, and broader community impacts. These are not easy stories to hear. I do not pretend that our bank, or any bank, gets it right in every circumstance. We aspire to act in a consistent, transparent, patient, and compassionate way. If we sometimes fall short of that mark, we will apologise and try to put things right. However, some witnesses have made untrue claims to the committee which we wish to address. We owe it to the 800,000 Australian households who own CBA shares directly and the millions who own our shares through their superannuation to clearly refute claims that are just wrong on the facts. Let me start with the purchase of Bankwest. In the lead up to the global financial crisis, Bankwest had grown its commercial lending rapidly, particularly on the East Coast. When the GFC hit, a higher percentage of these loans became impaired, and with wholesale funding markets freezing, Bankwest was unable to raise wholesale funding in its own right. It became wholly dependent on its parent HBOS to provide wholesale finance. Remember, this was a time when banks around the world were collapsing. When HBOS itself became troubled, there was an imperative to find a new owner for Bankwest, not so much to realise value for the assets, but more specifically to refinance the $17 billion of HBOS funding, which HBOS had in turn borrowed from the markets. The sale was agreed with urgency, and a deal was struck which was ultimately to the benefit of customers and shareholders of both Bankwest and CBA. It was also to the benefit of the taxpayer, given the alternative of a possible collapse of Bankwest. The committee has heard allegations that Bankwest engineered customer defaults to reduce the price that CBA paid for Bankwest. Allow me to address a range of these claims directly. CBA could not reduce the purchase price payable to Lloyds by impairing customer loans, and nor did it attempt to do so. We repaid all of the wholesale funding. Again, there was no clawback possible. There were no warranty claims in relation to impaired loans. There was no loan guarantee from the British government, and nor was there any capital benefit from impairing loans. CBA did not receive compensation from HBOS for any loan that was subsequently impaired. In early October 2008, CBA agreed to buy Bankwest for $2.1 billion with an acquisition date on the 19th of December. So just like when you buy a small business, you don't know exactly what the stock will be 3 months hence, and so you arrange for a stock take and a valuation of the stock on hand, and the purchase price is then adjusted accordingly. A bank's version of stock is mainly its loans. HBOS completed a stock take as at the 19th of December 2008. PwC and CBA reviewed the figures, and where there was disagreement, it was arbitrated by Ernst & Young. As a result of that process, the final purchase price was slightly higher at $2.126 billion. Let me emphasise, the price adjustment mechanism allowed for changes to the quantity and quality of Bankwest's loan book at the time it was bought by CBA. It did not allow for any clawback for loans which subsequently went bad. These are all matters on the public record. In audited accounts, we have provided to the committee letters from both PwC and Freehills, two highly respected firms, which fully corroborate our evidence to you. Since the acquisition, CBA shareholders have lost approximately $2 billion on defaulted loans acquired in Bankwest. At the date of acquisition, Bankwest impaired loans were approximately 2.1% of its book. This compared to an average of around 0.4% for the Big Four banks. This is due to a high exposure to commercial property and rapid expansion dictated by an aggressive global HBOS strategy. This strategy was systematically examined and laid bare by the British parliamentary inquiry into HBOS. It has also been the subject of a report just released by the Bank of England Prudential Regulatory Authority on the failure of HBOS, which makes for compelling reading. I quote in particular from page 110 of that report. HBOS Australia's push for market share often meant that it took on the poorer assets that others did not want. However, the scale of the problems at Bankwest is nowhere near the level that the committee has been led to believe. Around 40 Bankwest customers have provided submissions to this inquiry out of around 26,000 commercial customers on the books at the time of acquisition. The interests of the bank and our customers are aligned. That is, the best outcome is that their businesses flourish and they repay their loans. We only appoint receivers as a last resort. In 2009-2010, Bankwest appointed receivers to 116 entities, nothing like the 1,025 that Mr. Hall suggested to this committee. This was just 0.27% of Bankwest commercial customers. Now, on defaults, by far the majority are monetary. That is, the customer fails to repay principal or interest on time, including reasonable consideration for time extensions and so on. Non-monetary defaults are more likely to occur when financial difficulties have clearly emerged from issues such as not paying tax, not paying employees, not paying creditors, or having poor financial results. It is not our practice, and we are not aware of any circumstances where we have enforced based solely on security revaluation. In particular, we have examined 36 submissions that have been made to the committee by Bankwest customers, and in no case was a change in valuation used as the sole reason for default. Finally, I'm aware that there is an appetite within the committee to consider serious forward-looking policies which would support small businesses and strengthen the market for lending. As I have stated, the vast majority of commercial loans are advanced and repaid without difficulty. So we need to ensure that we come up with constructive ideas that do not have any adverse effects on normal lending. I'd like to propose 3 policy ideas which we consider are worthy of your close consideration. On the question of valuations, we agree with the principle that where possible, valuation should be prepared on the same basis going in as when an issue needs resolution and difficulty occurs. We also think it's appropriate that where we are the sole lender on a business loan, customers should be provided with a copy of the valuation that they have paid for, so that both parties have all the facts on the table in a time of financial stress. On the committee's concern about adequate time for resolution, we would suggest that there be a minimum of 1 month between when a customer defaults on a loan and when a bank requires full repayment of the loan as a result of default. On default interest rates, these exist for a number of reasons. From the bank's point of view, loans in default are riskier, APRA requires us to hold much more capital against them, and there is significantly more intensive work and customer contact for credit counselling and so on, which is costly for us to provide. There are many cases where we don't apply the default rates, as we recognise that higher interest rates can impinge on the cash flow of our customers. However, there have clearly been some very high rates charged, so we would be happy to see a standard industry practice for default interest rates. In conclusion, there was no way for CBA to benefit from any loan that went into default after the day it took ownership of Bankwest. CBA did not engineer defaults, contrary to claims by witnesses, and had no incentive to do so. We incurred $2 billion of losses on Bankwest loans and had no recourse to any other party for those losses. Although the number of loans in default are small in proportion to total loans, we do support sensible measures to assist customers in default to reduce the undoubted impacts. We look forward to taking your questions. Thank you.
Thank you very much. Can I have somebody move that we accept this written statement? Thank you. Mr. Lundy.
Thank you, Chair. Mr. Craig, I just wanted to drill down into the $17 billion figure.
Yep.
And just break it up, if I could. I'll ask you to help me break it up and see how it adds up. Am I right to assume, so we have 2.126 billion is the purchase price. You've got, in the accounts listed as intercompany payable, there was a charge to the Commonwealth Bank of Australia of 14.58 billion.
Which accounts are you referring to, Senator?
Bankwest.
Sorry, Mr. Lundy. In the Bankwest accounts.
I have a copy of it here if it helps.
Oh, right. No, I see.
You
This
see?
is the payment of the intergroup balance of 14.5, yes? That was paid on the 19th of December?
Yes.
Yes.
So there's the issue of the $4.6 billion.
Right.
I just want to understand how
Yes.
that all came together.
Yes.
And added to, because there's been all sorts of allegations made of 17 billion, 18 billion, 19 billion.
Yes.
Where did that 4.6 go? I know the Reserve Bank was involved. There were funds that needed to be paid back. I was just wondering whether instead of a headline figure, you could drill down inside that figure for me and explain the mechanics to the committee and those listening.
Absolutely.
Of how it all came together to get to that figure.
Absolutely. So, as I said, really the purchase and the need for the urgency of the purchase was about this funding, the fact that funding was very scarce, and everybody, all banks, were having trouble getting adequate funding. Bankwest indicated to us that they had about in September, they had about $17 billion owing to HBOS, but they weren't sure exactly how much that would be at the acquisition date. And so what we agreed, and of course you don't just sort of carry a few $1 billion of cash sitting around. So we agreed with them that we would pay $14.5 billion on acquisition date on the 19th of December,
Yep.
and any balance 6 months later. Now, what happened in the intervening period is it turned out that at the 30th of September, they had $17 billion owing to HBOS and $1 billion owing to the Reserve Bank. On the 19th of December, when we had to buy the business, there was in total just over $15 billion owing to HBOS, of which we paid 14.5 on that day, and there was $3.77 billion owing to the Reserve Bank. And we paid the Reserve Bank back in January. So in total, we paid 14.5 on acquisition date,
Yep.
3.77 to the Reserve Bank, and then $744 million on the 19th of June 2009. So in total, we paid $19 billion and $27 in finance. In total.
And that's outside of the 2.126 billion.
And that's outside. We also paid the 2.126. Well, we paid 2.1
Yep.
on the 19th
Yep,
of
and the
December, and the
26 came
26
later on.
That's right.
at the end.
Okay, that's the best explanation of the actual transaction I've heard so far. Chair, can I throw back to you for a little while I digest?
And can I just ask, Mr. Chair, Mr. Craig, the document that you're reading from might be of use to the committee, because clearly you were referring to figures in a pretty organised pattern, and that would be helpful.
Yeah, it's all in the submission that we put in on about a month ago.
Okay.
Yeah.
What part of the document are you referring to there? Because there are many, many pages, as you might be aware of, Mr. Craig.
Yeah, so this is on page 7 of a letter to the Secretary on the 8th of October 2015.
Okay, thank you. Thank you, Chair.
I'm happy for you to take
Oh,
the
okay,
call.
thanks very much.
And the Secretariat tell us where we find it?
Secretary's just pulled it up for us. They're even better than that, Senator. So, sorry, Mr. Ruddock. I would just like to go to some points in your opening statement. I know that the Secretariat have been requesting an advance copy for us to have a bit of time to look at, but unfortunately we've only just received it. Can I just ask you a couple of questions? We've had many, many claims that there was a clawback provision that was activated. You've definitively rejected that in your evidence this evening.
Yeah, so let me just make sure we're talking about the same thing. So there was a price adjustment mechanism to value the loans we purchased accurately as at the 19th of December 2008, based on information available at that time. So if an account failed after that date, it wasn't able to be provided for. If it was in default at that date, then it could be provided for. A clawback, in the normal sense of the word, is when something happens later, and because of that you can make a claim and get your money back after the event. There were no clawbacks. I mean, frankly, because of the state of both Bankwest and its parent, HBOS, we didn't particularly want to be relying on the ability to claw back from, indeterminate future owners.
Could I ask you about the percentage of the loans, the commercial loans? You indicate that there was 2.1% of loans that were risky and 0.4% was the amount that other banks had exposure to commercial loans. Is that correct?
Yeah,
Did
so
I hear
I
you
mean,
correctly?
the definition, so we've got to be careful about what we're talking about. So the definition of impaired is a Reserve Bank definition of impaired. So it's for accounts, how the Reserve Bank wants them reported. And the Reserve Bank style reporting, as at acquisition date, 2.1% of commercial loans in Bankwest fell into that category, and about 0.4% on average for the Big Four. So it gives an indication that on the commercial book, they had about 4 times more problems than the Big Four banks did at the
You
time.
state that's because the bank was aggressively moving into that market.
Yeah.
And so the argument for the Commonwealth Bank is that you purchased a book where there was a higher level of exposure than other banks at the same time.
Well, we purchased Bankwest, the bank, which was a very good business on the whole. It had been a great bank for many, many years, particularly its retail business, its consumer business was a great business, and particularly in West Australia. And it also had a very good business banking business, which we were keen to acquire. Unfortunately, in the last couple of years, it had grown aggressively, particularly on the East Coast, and because this was new areas for it and because it had grown very quickly, some of the later loans that they put on were of lower quality. But the underlying franchise was and is an excellent business.
Mr. Craig, you also spoke about your policy around appointing receivers, and we've heard a considerable amount of testimony from witnesses about many banks about the haste with which receivers have been appointed following the determination to put an investigative accountant in. Could you take me through the commentary that you gave us in your opening statement there regarding the number of entities?
So, Senator, you're referring to the commentary around the number of receiverships in Bankwest in the years 08, 09 and
Exactly.
09, 10?
And 910.
Yes. So we've provided those numbers to you to indicate the scale as opposed to what has been suggested in some of the submissions the committee has received. So Mr. Trevor Hall provided a submission in which he claimed that receivers in, I think, for 1,025 loans had been appointed by Bankwest. And so we have done some work to go through the files, and it's been quite manual work to provide those numbers to the committee.
So how could there be such an incredible difference between the figures that the bank's providing to us this evening? And you would have seen the evidence that Mr. Hall was basing his estimations on. Can you explain that discrepancy for the committee?
Well, it's very hard for me to know exactly how Mr. Hall was counting. What we surmise is that Mr. Hall was double and triple counting. So what it appears he has done is he has gone to ASIC records of receivers, and he has looked at a cumulative total for 2008, a cumulative total for 2009, and a cumulative total for 2010, and it appears he's added them together. Now, that's all we can surmise, but the figures that we've given you are actual figures from going and doing a count of our files, actually going through each file manually to determine how many receivers were appointed. So 66 and 116.
That's over 2 years.
That's over 2 years.
Yes.
That's correct. And these are the 2 years of most activity.
His numbers were for 1 year, but the 1 year he chose was a calendar year. In fact, the reporting through to ASIC is done on a financial year, so it was 66 for 2009 and 116 for 2010.
So if I took a 5 or 6 year period after you acquired Bankwest and asked the question, how many loans, commercial loans, were impaired, that's the language that we're using, what would that number be?
Well, I think, again, we're now talking different terms. So when we talk receivership, that's much more than impaired. So impaired merely meets a definition of it's in some form of trouble, and we have a responsibility to classify it in that way and report that to ASIC, to APRA.
I'm just trying to understand
Yeah.
the magnitude of it, because the impression I have is that the numbers of loans commercial loans, as distinct from residential loans, that were either not functioning in the way in which you would expect, I guess that's what you mean by impaired, or those for which you have appointed receivers, is proportionately much higher than you would expect in other banking institutions, and I think you've admitted that. And I'm trying to understand the quantum and size of the problem.
So the best way of describing that, I think, is to think that Bankwest had around about 5% of the market share of lending, commercial lending in Australia, and it had about 9.5% of receivership appointments. So it gives you a sense, a little bit less than double, and that's pretty indicative, I think, of the quality, the relative quality of lending of Bankwest's book compared to the average in Australia. But that's the sort of scale, but certainly not the 1,000% or whatever that was proposed.
Mr. Ruddock, I could give you a few numbers that would give you a sense of it if you'd like. We have actually provided, in response to one of the committee's questions on notice, we've provided some numbers of write-offs. So
yes, I've been trying to read the massive amount of material, and I thank you for it. I've almost suffered intellectual indigestion trying to read it all.
well, if I can give you perhaps just
So if
two
you can
numbers.
help guide me, I'll be...
So I'm referring now to a letter of ours dated the 10th of November 2015 to the committee, and it's our response to question 5, which is on page 2 of that letter.
10th of November.
I'll wait till you pull it up before I continue.
Yes. The clerk can help me. Which pile is it in?
The 10th of November, did you say, Mr.
10th of
Cullen, or
November,
10th of December?
page 2. That's right, 10th of November, page 2. Under the heading of performing loans, halfway down that page, you'll see a small table. Underneath that table is a paragraph commencing of this performing book. Sorry, Ms. Rack, you...
Write-offs incurred for the period 19 December.
2008 to 2015.
Found 10th of November.
Yes.
First, all right, page
Page
Two.
2.
Yep.
That's right, halfway down the page.
Got it.
Under the heading performing loans, the paragraph immediately under the small table there, what we're disclosing there is that, and these are write-offs, so these are not impairments, for accounting purposes. These are actual write-offs where we have written off loans that have been unrecoverable. And you'll see there that on line 3, that the commercial portfolio, there were 1,958 loans where we incurred a write-off in that period, 19 December 2008 to 30 June 2015. So as a...
1.694 million.
That's right, $1.694 billion. And so that gives you just a sense of, over that 7-year period, the number of loans where losses were incurred.
What were those years, Mr. Cohen, sorry?
30 June...
0809?
08.
15.
30 June 19 December 2008, from the date that CBA acquired Bankwest, through to 30 June 2015. So that would give you, hopefully,
No,
a sense of...
I appreciate just trying to get some idea of the magnitude, because there is an issue, and people have been looking to find out why they think the bank may have behaved as they think it did. And what you're saying is, and I understand it, the loans that were where receivers were appointed, bound to be impaired. You couldn't, if it was by a certain date, you could claw the money back, but if it wasn't by that date, you couldn't claw it back. And you're arguing that there were no warranties that would provide an alternative mechanism for clawing it back, which some people have suggested to us was a factor.
That's right.
And I'm trying to understand, why, rather than allowing people to try and bring developments to fruition, you would move as quickly as you did, and to have a 1.6 billion loss, is what you're saying. Why would you do it?
So over that 7-year period...
And I say to myself, is there anything around the sort of APRA requirements that would influence the proportion of your commercial loans that you wanted to have?
That's a good question. It might be helpful. It's a good question. It might be helpful if I just hand out to you something that just talks about this speed question and how we recognise for accounts versus how we recognise for the write-offs that you're seeing here. Would it be helpful?
Thank you, yes.
Could I just ask one question, Chair, sorry to interrupt colleagues?
I move that we accept these documents, please.
Yeah, I'll do that. Mr Craig and Mr Cohen, 66 in 08-09, 116 09-10. Can you give me the figures in 10-11 financial year?
Not at the moment, Senator. We're still doing the count.
Right.
This chart that David Craig has just mentioned won't talk to receiverships per se, but it will talk to the losses incurred in later years. So it's...
So I was looking for a breakup of them.
Yes. So we don't have the full count yet. We're still doing the count because it has been a question that the committee has asked us. We've given the answers so far, but as I mentioned before, we actually have to do a file-by-file review. We don't have this receivership data just stored electronically. We actually have to open the file, read through it, see whether a receiver is appointed and go through all the files.
So I think the key here is that the blue lines are when we recognised losses in our financial statements. So we are required by APRA and of course by accounting standards to recognise potential future losses as early as it becomes obvious that there may be a problem with accounts. And then the red bars are when we actually resolved the account with the customer and wrote off balances. And as you can see, there is a multi-year lag between when we first recognise that there might be a problem with a customer. Obviously, we then try and work through with the customer and resolve the problem. And many years later, finally, if all else fails, then we have to write off the account. And as you can see, there is this enormous lag. And so we certainly do not move with haste on these issues. Quite the contrary, we try very hard. It's in our best interests, and exactly as you've said, Mr Ruddock, it's in our best interest not to have a problem and not to write off accounts. We certainly don't want to do that.
So that graph, Mr Craig, for example, financial year 2010, the blue line, is that 1139 million, is it?
Yes. That we wrote off against Bankwest's accounts in that year 1.139
You would add a
billion.
lot of...
Sorry?
You would add a lot of customers there who go belly up, no doubt.
No, it's nothing to do with customers. This is an accounting provision that was booked in the accounts. We only had $71 million of customers going belly up that year, but we accounted for and wrote and recorded in our accounts 1.139. The red is the customers, the blue is our financial results and what we have to report to APRA.
If I could, Mr Ruddock, just return to your question about the speed that you referred to. It might be relevant to know that the average period or the average number of days where a customer is being looked after by our team that manages troubled loans is about 550 odd days, I believe. And that's the time from when the loan becomes sufficiently troubled to be taken out of the hands of the normal relationship manager and goes into this team to resolution. So and the reason for that is because our practice is to try and come to a resolution that doesn't involve a sale or a forced sale of the properties. That's the last resort. It's not the first resort. And so attempts are made with customers to reach arrangements that might involve the injection of more equity or the sale of assets or some other assistance, pay down loans, for example, to make interest payments more feasible. So it's actually not in our interest to move to a quick resolution that involves a receivership.
I will give the call back to Senator O'Neill, who was partway through a line of questioning when...
Thank you very much. The great minds think alike across the committee, so there were a number of questions followed there. But I would like to, on the back of the commentary just there, go to your opening statement where you talked about reasonable consideration time extensions, and we are talking about time. So I'm aware that the questions I'm about to put on the record may be ones that you will need to take on notice, but there is a considerable amount of testimony now that indicates a very different version of the way in which the Commonwealth Bank proceeded with a number of customers. And their public statements are now on the record, and the questions that I'm going to ask and the documents I ask you for are to provide a counter narrative that we can see for ourselves that might be able to balance off against what we have had reported to us at this point. So for the matters raised in submissions and the evidence that we've received from Mr Bowman, Mr Cavassini, Mr Erickson, Mr Evanian, Mr Lavis, Mr O'Brien, Mr Power and Mr and Mrs Schomburg, could I ask the Commonwealth Bank to provide for us these items? A timeline and evidence documenting the bank's attempts to assist these customers from the time that it first became apparent that they had financial difficulties. The dates on which the properties were valued by the bank. Are copies of the instructions given to the valuers for each of those valuations. What the valuations were, copies of the valuation reports. Information on whether the valuers were registered certified property valuers, copies of instructions to receivers, final statements of accounts from the receivers, any information where the bank challenged or sought to control the fees charged by the receivers, where investigating accountants were appointed, the instructions to the investigating accountants, information on whether the investigating accountant and the receivers were both from the same firm or company, the findings of the investigative accountant, information on whether there had been any secondments of staff to or from firms or companies of the lawyers, investigating accountants and receivers involved with those cases.
So, Senator, I believe the committee has already given us a formal question on notice containing all of those requests. So we're in the course of preparing the documents.
And I'm really mindful that it's quite an ask.
It is quite an ask.
But
we'll
this takes us to the heart of the matters, and in fact, we'll look forward to receiving it at your earliest convenience for our consideration, and I'm sure that it will shed some light for those people who have come to see us about what actually happened to them. I would like to take you, though, on the back of that to the policy ideas that you put forward, which I think are a response to some of the issues that are probably embedded in the questions that I've asked. So you talked about the question of valuation. So I think it was very disturbing to have many of the submissions and applicants before us say that the valuations that they were so critical to them being impaired were never allowed to be seen by them, although they had to be paid for by them. You're recommending a change here. Why was this the practice of the bank? Why does it continue to be the practice of the banks with regard to commercial loans, that if an investigative accountant is determined to be necessary by the bank, that it is enacted and that the person then has to bear the cost of that investigation? Alongside the same thing with valuation. So what's the current policy? Why has it been that way for so long? And why are you now making this recommendation?
So if I can perhaps start with investigating accountants. Usually where a loan is looking as if it is in trouble and a decision is made to put in an investigating accountant, the purpose of that is twofold. One is for the bank to understand more about the business and how it is really travelling. And the second is for the investigating accountant to be able to give greater depth and insight to the customer about how the business is travelling.
Can I ask you how many investigative accountants you employed in this period of time?
I don't know the answer to that. We can take that on notice and give you the answer, Senator. I don't know.
Rough number, thousands, hundreds?
You mean the number of appointments, the number of times an investigating accountant, I would imagine is in the hundreds.
Okay.
At a guess.
And of those hundreds, let's just pick a number. say of 800, how many of those would make a recommendation back to the bank that nothing should happen, or you should just help this business in some small way, and how many would recommend that you further act to move towards defaulting the loan?
Generally speaking, an investigating accountant's report will throw up a number of options. So it won't necessarily be a single option such as this loan isn't going to make it, a receiver should be appointed. It's usually a number of options. Those options are discussed, and the investigating accountant's report is shown to the customer when it is finalised. And it needs to be, because the options often involve action by the customer. So to give you, I couldn't give you an exact percentage of those hundreds, but always the investigating accountant will come up with recommendations, and they're usually, as I said, not a single recommendation. There are various options. The bank then considers those options and discusses it with the customer, because often action by the customer is necessary, such as partial sale of assets.
So in what percentage of cases did it end well for the customer?
I couldn't tell you, Senator, off the top of my head. We'd have to go and review the files to do that.
Because from the evidence that we've received, it's almost like the minute an investigative accountant goes in, it's all over for your business.
All I can say to that is I don't think you've heard from any customers where, following an investigating accountant going in and taking up options or recommendations from the investigating accountant, the loan has returned to good health. So what I'm saying is I think you're getting one side of the story from people who have not had a good experience, where an investigating accountant has been appointed and subsequently a receiver is appointed and the properties are sold, for example.
And that's why I'm giving you the opportunity to put on the record the percentage where it's turned out well for the customer.
And I think the questions that you raised earlier and that have been delivered to us by the committee, that'll come out in those at least those named files. We could do further work to find that out for you across the broader range of files, and we're happy to do that, but right here and now I can't tell you that answer.
So what's your sense, Mr. Cohen? Does it end up better for the banks or better for the customer? And which way does the coin fall?
Well, I think it's important to understand, and I know the committee has heard this from time to time, not just from our bank, but from other banks as well. It is a fact, however, that, as I said earlier, appointing a receiver is usually the last resort, because invariably, when a receiver is appointed, the bank does not recover all its money. And of course,
how
from a
much
customer...
does the bank expect to recover? When you appoint a receiver, what is the minimum amount that you would be satisfied in receiving? Do you have a policy around that?
No. There is no minimum expectation. The appointment of a receiver is an indication that there is no alternative to getting back some of the money. Once a receiver is appointed, the intention is for the receiver to achieve the best price possible for the assets,
Mr. Cohen,
to maximise recovery.
I'll ask you a question following up on that. What's your write-down policy?
Write-down policy?
Do you
In
have
terms of when we decide to write down?
In terms of when you're looking at an asset that's distressed, what's your policy in terms of what's the percentage of that asset you're prepared to lose as part of a foreclosure?
Right, so that's really an accounting question. So there's two stages, and again, it's the blue lines and the red lines. The red lines are we've lost money, we have a tax deduction. The blue lines are we are required under accounting standards and under APRA regulations to correctly grade accounts and to provide for them. So, for example, if we lent to the Australian government, we would have to carry a provision, a collective provision, against that loan to the Australian government in case it collapsed. Now, as a highly rated borrower, we wouldn't have to carry very much of a provision, but every single loan on our books has a provision against it, and if the customer gets downgraded, obviously with big customers there's a Standard & Poor's rating or something, but with smaller customers it's based on evaluation, then as they get downgraded, the amount of that collective provision increases for every grade they go down. Once they become impaired, we have an obligation to pick up the file, look at it, study the file individually, and work out what is the likely loss on this file over the life of the account, and we're required to provide for that potential loss then and there. And that's why you see those blue lines, being high so much earlier than the red ones. So we take the loss, or the potential loss, as I said, many years before things happen. That is totally independent of how we actually deal with the individual customer. That's purely an accounting valuation of the loan book required under the Corporations Law.
Chair, can I just ask something on that? I'm confused,
No,
Mr Craig.
what's the write-down
I'm
policy?
confused.
Write-down
Did I read in your submission that an impaired loan is when you actually lose money when you cash the whole business in?
No.
No. An impaired loan is a definition from APRA of when you have a potential problem. So, for example, with a consumer loan, it's automatically impaired if it goes past 90 days overdue. As soon as it's 90 days, it's immediately called impaired.
Right.
With commercial loans, it's a question of how it's graded and whether it's repaying. And usually it means they're not paying their interest or their principal. They've missed some, they've defaulted on something.
So Mrs Marlis, you have follow-up, then we'll go back to Sandra.
Yeah, I don't think I got a clear answer to the write-down policy, but nevertheless, we'll keep prosecuting that one. You said that you only appointed that 116 and 66 cases to receivers, but then you said you had hundreds of investigative accountants going through work. So I understood from previous conversations that banks are in a position where they don't actually have to pull in a receiver. They can actually start the process within their own institution. So would you have brought investigative accountants into those cases as well? And might that not increase the number of impaired loans or loans that you ended up saying, close up shop, you're out of terms? Would that have increased the number of foreclosures?
So if I understand the question, Ms Marlis, are you asking whether we may have put internal people in rather than appoint an investigating accountant? Yeah. It's, in all cases that I'm aware of, we actually place an external person in the role of investigating accountant, partly because we're not resourced to do that, partly because we don't have the expertise. Investigating accountants are usually appointed because they have particular expertise in the type of business run by the borrower. And the bank doesn't have that internal expertise, and so we use externals.
And so would there never be a situation where the bank then went through the shutdown process without appointing a receiver as a result of that investigative accountant's work?
In the case of commercial loans, where a business is being run or property is being developed, etc., we would appoint an external party as a receiver. You're probably aware that a bank is able to exercise a power of sale, where the bank can sell the property. In commercial contexts, the bank doesn't do that itself. Again, for the reasons I gave you before relating to investigating accountants, we don't have the resources to do that. We don't have the expertise to do that. We rely on professional firms that do have that expertise.
So what about when people are using their home as equity for their business?
Mm-hmm.
What's the process that you use there?
So in circumstances, if such a loan became troubled and eventually was unable to be worked out and a receiver was appointed, for example, the receiver would be appointed over the security granted by the business itself, so it might be the land owned by the business, and the receiver would also be appointed over the home owned by the business owner if that home had been granted as security. And then the sale process for each would follow.
Okay. I have some papers here, and forgive me, I will not be able to put my hand on it straight away, where it indicates that the client of Bankwest did not receive the notification. I'm confused now as to who actually had ownership of the loan, because the answer in response to one of the CBA's responses said there was plenty of correspondence going back and forwards between that client and the Bankwest bank, but as I understood it, it was the CBA who came in at the end and said, too bad, so sad, finish up. So, and there had been no correspondence between the CBA and the client. So we get one story from the CBA saying there was plenty of correspondence, but it wasn't Bankwest who actually said, you're done. It was the CBA.
I think, Ms Sudamas, you might be referring to Mr O'Brien.
I think it is.
Mr O'Brien did say that he had not had any contact from Commonwealth Bank over a 4 or 5 month period, and I think in his testimony suggested to the committee that that was problematic. So if that's the one you're referring to, what I can say to you is that Mr O'Brien had two lenders. One lender was Bankwest, and the other lender was Bank of Scotland International, which was a subsidiary of HBOS. And there was a lot of dialogue and interaction between those two lenders and Mr O'Brien, as you would expect, because they were his lenders. They were the people that were owed money. Mr O'Brien seemed to be suggesting that there should have been regular communication to him from CBA. That's not the case. There wasn't. He is correct in saying there was no correspondence or contact from CBA. He's absolutely correct in saying that. And there's a very good reason for that, because CBA had no relationship with him. CBA was not the lender. CBA did not have a contract with him, and that's why he did not have any contact with CBA, but he did have a lot of contact with Bankwest and Bank of Scotland International.
Now that's page 3 of your letter of the 1st of December, and I was reading your observations that there was no specific communication with your bank because you weren't a party. However, there is extensive dialogue evident. I don't know what dialogue means. I don't know what demands were made. I don't know whether dialogue was ringing up to say, you know, what's the weather like? Can you give us the diary entries of the discussions and the dates in which you allege officers of presumably Bankwest and Bossi, is it?
Bozzy, yes.
Bossi?
Yes.
I think I prefer mine, Bossi. That evidences that?
We can certainly provide that too. Yes, I don't have it right here
I mean,
now.
it's
For
well, it says that that there is an extensive dialogue between Bankwest and.
Yes, there is. We can certainly provide that. It might be of interest to you to know that in the court proceedings between Bankwest and Mr O'Brien swore an affidavit which set out at length his various phone calls and correspondence with Bankwest. So we can certainly provide you with our records and his.
It really goes to what those phone calls were about, and whether he was clearly led to a view that he was in default and there may be consequences arising from that. You know, I mean, one gets the impression when you hear some of these people that there is a demand made which they were quite unaware it was likely to come, and they were given no time to be able to go and negotiate with anybody else to try and meet that commitment. And if they had had an opportunity, they may well have been able to do it.
Yes.
That's the nature of the allegation. And the words you use are so vague, I don't know what the conversations were. I don't know what impression he got from those discussions he was having, that's all.
More than happy to provide it, and when we provide it you will see that the dialogue concerned extensions of his facilities, his attempts to bring in equity, his attempts to bring in a hotel manager, the fact that his loans had expired, the fact that we needed to do something about that. So all of that will be very apparent to you.
Senator O'Neill, back to you.
Thank you. Can I just go to some of the points that Ms Sidmalis raised around investigative accountants and the bank not having that facility within it?
Yes.
I've been given a number of profiles of people who make claims that they currently work for companies which are receivers, such as Quarter-Mentha, McGrath, Nickel. They're receivers, aren't they?
Yes.
Okay, so when I read things that say, I also went on an extended secondment to Bankwest, see below, I managed a portfolio of exposures, predominantly in property, as well as managing the department in Brisbane following the departure of senior personnel to a competitor, and this is around Bankwest. And there's pages and pages of them from insolvency companies who actually became employed in Bankwest in that period. Is that common?
So the first thing I would say, Senator, is you'll recall that this was a period of the GFC when there was considerable pressure on businesses, and where loans went bad and action was being taken to recover loans, there was a lot of pressure, particularly in Bankwest, a lot of pressure on what had been quite a small team in their recovery team, if I can call it that. It's the loan management team. It was quite a small team. It certainly didn't have the resources to be able to handle the number of loans that had started to go bad as a result of GFC and as a result of business pressure. And so it was, at that time, it was necessary to bring people into that team. Some of those people were brought in from external bodies, such as the receivers that you mentioned. CBA also sent some people into that team to assist because it was simply not able to cope with the quantity at the time.
So when you say you sent some people from CBA, you're talking about you sent some of your bankers in to Bankwest, or you also got receivers and paid for them to go into Bankwest?
No, as far as I'm aware, what we did is some of the people from our loans management area were seconded into Bankwest to assist Bankwest with the workload.
Okay, so we've got people writing, I manage a portfolio of troublesome and impaired loans. My skills were enhanced with my 12-month secondment in the credit structuring team at Bankwest. I worked on a portfolio of the bank's high-risk clients where I met with them to understand their business, develop suitable solutions in view of the bank's requirements. Restructuring facilities. Was this project called Project Magellan?
No, that was something completely different. It was an accounting exercise, which David can speak to. That was an accounting exercise, not a loan management or restructuring exercise.
Right. So let me just be clear about what you've just said and make sure I understand. So that at the time of the GFC, when this purchase of Bankwest was going on by CBA, basically we went, well, look, we're worried about this. We better put a whole lot more staff in there. And against usual practice where you have the receivers at arm's length from the bank, at this time you actually employed receivers, you brought receivers into the bank.
We brought receivers into the bank to assist those staff do work which is not receivers' work. And I think that's a crucial difference here. So they didn't come in and act as internal receivers. What they did is they came in and they assisted the Bankwest staff do the role that they needed to do in the restructuring area and in the loan management area. So, for example, I think one of those excerpts that you read out there talked about somebody's experience having been enhanced through a 12-month secondment and working on some high-profile, troublesome and impaired loans. So we would have people in our restructuring team who would be charged with the responsibility of working with a customer to see whether a troubled loan can be made healthy again. And these people who came in and who were seconded assisted them to do that work.
So was there any transfer then of those people from outside the bank as receivers into the bank to help your credit assessment team? Did any of those people then become investigative accountants and become receivers? Like, did they complete the circle?
You mean
they go in?
The individual person travelling through that loop?
Yes.
I don't know that, to be honest. We could look into it for you. I don't know it. I would say that it's quite feasible that one of the external firms who might have provided a secondee might also have been appointed as a receiver at some stage. That's highly feasible given that we were taking secondees from some of the large firms.
So before I know Ms Sue Miles wants to ask a question on that too. So this is one of the concerns that has been expressed to us, that it was all an insider job, if I can put it that way, that, you know, the people who are inside the profession go in, they help out the profession, and this is a nice, cosy little arrangement between the banks, the receivers, the investigative accountants, you know, IA, they're called an IA, and I thought they were independent originally, but they're called investigative accountants. Yeah. This seems to be a very intimate insider connection of people who know one another and are not providing a degree of transparency or information to the clients, particularly when the receivers start to then get involved with seeking valuations and the assessment of valuations, the assessments of the capacity. And we've heard from business after business that the people who were appointed to them, you know, we had them described, I've got nothing against 22 and 23-year-olds, but, you know, we have people with 30 and 40 years experience in business saying, look, their figures were wrong. They didn't understand the business. They weren't accounting for, you know, the changes in stock that vary with different seasons. There's been quite a degree of critique about the incapacity of those people who were put in those potential life or death decision-making roles for the businesses. Have you got any response to that, Mr. Cohen or Mr. Craig?
Yes, I do. I'm aware of the particular evidence you're talking about. I've read those transcripts. We have a very different version.
Well,
and the 20-year-old...
This is the opportunity, Mr. Cohen.
The 20-year-old that is spoken of in that particular, believe that was Mr. Power. The 20-year-old that Mr. Power spoke of was somebody who worked in one of these firms, but he wasn't working alone. He was working under the supervision of a very experienced partner. I know Mr. Power was critical of that 20-odd-year-old person's knowledge, but the assignment wasn't done just there and then in that one meeting with that young person. The assignment was carried out by the investigating accountant outside the pub as well. So I'm aware of that. Can I just also say that in relation to the concern that has been expressed that perhaps there's a very tight circle of people who internally refer work to each other and it's all a bit of a club, I think that's a sort of suggestion, isn't it?
Yes, it is. That is a suggestion that's been made on many occasions, Mr. Cohen.
I understand that to be the suggestion. It seems to work or have a starting hypothesis that says there is some advantage to the bank in all of this. And that just isn't true. It is to no advantage to the bank to have a receiver appointed. And so to the extent that there is a claim that there is a club that's going on for the benefit of perhaps the bank in the end, we just reject that completely. There is no advantage to a bank in putting in a receiver. We can take you through each of the files of both named and other customers and show you how much we have lost every time a receiver has been appointed. It makes no commercial sense to put together a club of people so we can incur losses.
I might just add, I was a chartered accountant, I'm a chartered accountant. I worked in a chartered accounting firm, PricewaterhouseCoopers, for 27 years. They provide, amongst other things, insolvency services, although relatively small compared to these more specialist firms you've described. It is a very normal practice, and I'm sure when you talk to insolvency firms, as no doubt you will, that they run on a pyramid. And, there's a lot of work to be done, and they have people, with their L plates on, and they have people much, much more senior, all supervising one another and all checking each other's work. So, major decisions will not be being made by very junior staff. They may well be doing the work of gathering the materials and so on, but all of the key decisions will be made by the partner. There's obviously ethical and professional standards around the quality of work and how these guys do their jobs, and I think they're pretty rigorous, but I'm sure you'll be able to look at that. But they're totally independent of us, obviously, in the sense that they're independent firms and they run their business and they're governed by separate legislation.
So, Mr. Miles, I'll come to you. I just want to follow up on just one comment you made there, if I could. Mr. Craig, you said that Magellan was an accounting exercise. Is that correct?
Yes, so if you want to, would you like to hear a little bit about Project Magellan?
No. All I'm wanting to understand is, to the layman, hearing something as an accounting exercise means it's theoretical, it's for the books, it's for your prudential obligations. It should have no material impact on the businesses that are the subject of that accounting exercise.
Yeah, that's broadly correct. So again, if I sort of just refer to this chart, what we were finding through this period is that many more accounts were becoming troublesome and indeed failing without being on watch lists. What should happen if we're running our process properly is we first become aware that a client's starting to have some trouble, we're close to them, we get a sense of it, they might then miss a payment or not, and then it gets put on a watch list, gets made troublesome, and then progressively is managed through the process. We were finding some cases of clients that overnight were failing and that we weren't aware were in trouble. So under my obligation to be making sure that they're properly going through the funnel, and indeed this is very much the APRA requirement that we're on top of accounts and grading them correctly, we decided that the only way we were going to clarify this is now 18 months after the acquisition, 18 months on, was to conduct a very thorough review in the lead up to preparing the accounts for the year ended the 30th of June 2010. And so we commissioned an exercise to look at 47% of all of the commercial, by dollar value, of all of the commercial books in Bankwest. We looked at 1,200 files to make sure that they were properly classified and in order, basically. And as a result of that exercise, we did set aside further collective and specific provisions on accounts. But that was an exercise to make sure that once and for all, we had the correct provisioning. And, that led to this big spike, but as you can see after that, we returned to a more moderate and expected.
Set aside
hang on, Philip. If this is an accounting exercise that doesn't impact on the business it's concerned, but it's purely for your provisioning, can you clarify, did you have a number of reasonably senior managers in the Sydney area resign around that period in protest?
In Bankwest, Senator?
Yes.
In Bankwest? I don't know the answer to that question.
We
We can look into it for you, though.
I have an email here that I'm happy to give you a copy of, and it's titled Bankwest Update Project Magellan, 7th of July 2010. Yeah.
I think we're aware of that, Secretary. We're aware of that email,
Okay. So,
which talks of lots of people having left the Sydney office.
yeah, the bankers are furious, as they say. Many of the files are fine, and the cost is going to kill their clients. And that talks about them leaving. If something is an academic exercise for accounting, why would these people have said the cost is going to kill their clients?
Well, I don't understand the cost point, but there would be no doubt that as a result of reviewing 1,200 files and finding a number of them poorly managed, that certainly we would have asked some staff to leave who had not been doing their jobs properly. We needed to ensure that the relationship managers and the people involved in managing accounts are doing the right job and are on top of their accounts. So certainly an outcome of Magellan was some people would have been moved in their roles, and so there would have been some morale or other issues, or some people going. Now, we don't tend to advertise, why people go. In other words, we don't sort of put out a memo to say so-and-so's been sacked, but certainly some staff would have seen that there were some exits at that time, and some of them would have been in relation to poor performance identified by this review.
That's not what this is saying, though. This is saying they left. They weren't sacked. This is saying they left. And it's apparent, another line saying a firm who, because you've seen the email, has apparently tried to line up to do all the IAs, but the bankers are revolting, saying that they have a conflict and shouldn't do any of the work in these files as they make the recommendations.
I think this is an email written by someone in an outside organisation speculating about what's going on within CBA or Bankwest. I think it's a highly speculative document.
Well, according to the email, and again, we're just going on what we've got here, but according to the email, it was somebody from within Bankwest who had provided this information to them. So that seems a little more certain than speculation.
Well, the reference there to people having left is, as David said before, when people leave, they're not necessarily going to say they've left because they were forced to leave. They often say, I've left of my own accord, and that's a very common occurrence. So my only caution would be, I don't think you can read too much into the fact that it says they've left.
Mr. Marlis.
I was going to allude to that particular email as well, but you've mentioned so many times that it's not in the bank's interest to cause loans to be defaulted, and on the micro scale, that's probably 100% right. But from my understanding of what you said earlier, was that if you had too many what you perceive to be at-risk loans, then your cost of finance would have increased drastically. So in a macro scale, there is a financial benefit to a bank to get rid of what they perceive as being risky loans. Did I understand that correctly?
No, I haven't said that.
I don't think that was a question, Mr. Craig.
Sorry?
I don't think that was a question. This is about Tier 1 and Tier 2 loans, isn't it?
Yeah.
Okay, so as a non-banker, can you help me understand what it costs the bank to get credit as a Tier 1 bank as opposed to a Tier 2 bank?
Oh, for the credit rating of a bank itself?
Yes.
Okay, so yes, higher credit rated banks such as the Commonwealth Bank and the big four banks in Australia that have AA- credit ratings are able to borrow more cost effectively than a bank that's, say, graded B grade in international markets.
And that B grade is sometimes called Tier 2, is that correct? How many tiers of banks are there?
No, I haven't heard I haven't heard that description.
Okay, so we'll just use your terminology, level A with the low cost.
Well, I'm just talking about Standard & Poor's credit ratings. So if you're talking about the gradings of banks, so the big four banks in Australia are AA minus, and then say the regional banks tier down from there, and so have slightly higher costs of borrowing because of that internationally.
So that goes to, I think, what Mrs. Idmalis was saying, that being a tier 1 bank, you're able to get your money cheaper. When you're a tier 2 or a lower rated bank, it costs you more. Okay?
Yes.
What was the status of Bankwest?
Well, as soon as Bankwest was acquired by CBA, CBA took over its funding, and so it immediately got a benefit from cheaper funding because we were able to fund it under our AA banner rather than under its previous banner. So its cost of funds improved.
But you go on.
So the question is, what drives a bank down and away? How do they lose their credit rating? Is it not having a large number of what are perceived to be risky loans?
You lose your credit rating if you have large losses and you have poor capital and you look like you're not going to do so well. So it's, in a sense, again, not in our interest to be writing off loans because that's increasing our losses and putting us, potentially at risk. Now, I don't think we ever came at risk of losing our credit rating because of the strength of the CBA group as a whole. But no, that was not an indicator, and certainly it's not a reason why you would certainly not want to make your client lose money in order to preserve your credit rating. Quite the opposite. It actually brings on the problem.
Well, the scary thing for us, well, certainly for me, is that there appears to be a number of Bankwest loans that were on the loan book that were not seen to be anything other than at watch statement, called at watch level. And then within a short period of time, they then became highly at risk. And it was through this accounting process that their rating changed from being watched carefully to default. And there's been lots of different things that have said that. And it was during that accounting process where we understand that happened, which is why we're given to understand that a whole stack of what other people have said are ethical people have left Bankwest. We can say this is two sides of one coin. You're saying they were booted out because they'd recommended lousy loans, and they're saying we didn't actually do that. Those were made into lousy loans and we didn't respect the way it was done.
I think it's really important to understand what default is. A default is when a customer breaches their loan agreement. We do not default accounts. We have a contract between us and the customer, and if a customer doesn't pay us their interest, or if a customer has poor financial results or whatever, then they may well be in default of their loan agreement. But we do not default customers.
I'm sorry, but there's been a misunderstanding here, because we understand that by a bank not communicating to a client and not letting them know that their facility has been closed 3 months ago and they are now in default because they haven't paid their payments, their understanding was that they were going to get a continued facility. But by the bank not talking to them, it gave them a position where they had no option, no money, and they were in debt. So that's part of that problem, that whilst you say that you talk them through it, there's a gap here, David. There is an absolute gap, and it is so apparent in them. And I hear where you're coming from, and I hear where the other side is coming from, and they're not melding.
I think it's really important, if we're going to talk about these, we're quoting lots of individual specific cases from memos and so on. I think it's important that we take each one in turn, because we do have a response specific to each case. We've done a lot of work around the comments that have been made by people who've appeared before you, and we'd be very happy to take you through it. But in general, there are two sides to these cases, and you're only listening to one side at the moment.
And Mr. Craig, I recognise that you have done a lot of work. We've only just received those, so
I understand that.
Many of the committee have probably not had a chance to go through those in detail because they've only just come in. We may well come back to you if we want to go through case by case, but tonight I'm keen to proceed with some other issues. We haven't given either Senator Williams or Ketter a chance yet, so Senator Williams, you have the call.
Thanks, Chair. Thanks, Mr. Cohen, Mr. Craig. First question, did you, when HBOS went belly up, Bankwest was under a lot of trouble, were you pressured from anyone in government here, Mr Rudd, Mr Swan, or anyone to actually buy the bank?
We were not pressured by anybody to buy the
Were
bank.
you asked to buy the bank?
However, as you can imagine, in the middle of the GFC, all of the banks were talking to all of the regulators, government, not just in this country, by the way, but I suspect all around the world. We were being monitored, for example, daily by the Reserve Bank and by APRA on our cash positions.
Mr Craig, I'm sorry, but we're very short of time. Just a simple question. Were you asked by anyone in government, Mr Swan, the Treasurer, whatever, to look at buying Bankwest? Yes or no?
As far as I understand, Senator, we were not asked to buy Bankwest. It was a commercial decision that we made. If we had decided that Bankwest was not attractive, we would not have bought it regardless of being asked.
So you weren't approached by anyone in government to say, look, will you please have a look at this bank, look at buying it that's in trouble?
No, we were in discussion with the Reserve Bank, we were in discussion with APRA,
Yep.
and there were discussions about the health of HBOS as the parent of Bankwest. I am aware that towards...
Which was not good health, Mr Cohen, was it?
I beg your pardon,
The
Senator?
health of HBOS was not very healthy.
It was not, and there was serious concern by the British government, so much so that ultimately it had to bail out
yeah.
Lloyds that bought HBOS.
Yeah.
But I am aware, and this was not a conversation I was part of, but I am aware that towards the end of the processes we had decided to buy Bankwest, and bear in mind that our decision to buy Bankwest was not a decision taken lightly. It went to the board, it was a full discussion at the board level, and we went through the pros and cons, the business pros and cons of buying Bankwest, and we made the decision to buy it. I am aware towards the end of that process there was a brief discussion, I understand, between our then CEO and the then Prime Minister, where I think there was a confirmation that we were going to proceed. I'm not privy to the contents of the discussion.
For those 1,958 loans impaired, I think it was, for the 7 years, you'd have no idea what proportion of them were prior to your acquisition of Bankwest and post. Would there be a blend of them? Would that be too much work to find out, too much trouble for you?
We have actually answered that question.
Yep.
So
Sorry, I was asleep.
No, sorry, in the
in
submissions.
some of our submissions.
Sorry, if I read everything come off, so I do nothing but 24/7 read.
No, well, shall we refer where they are to make it easy for you?
Yeah, if you could, that'd be good, thanks.
So there was a letter on the 10th of November.
It's the
Same letter,
we were
and
referring
in the
to.
covering note on the letter that we referred to earlier, it specifically says the portion that was, so the total Bankwest loan impairments on the commercial loan portfolio was 1.866. Of this, 1.656 million is attributable to pre-acquisition commercial book.
So you're looking at about 210 million afterwards.
Of loans that were
Yes, commercial
written
loans.
afterwards. That's
Yep.
right.
Between up until 2015.
Yeah, fine. So all but 210 million was burnt from the previous purchase, 210 million post-purchase.
Correct.
Mr Cohen, I think in evidence in the 2012 inquiry, evidence was given from Bankwest. Since 2009, a number of Bankwest business customers placed in receivership has been small, less than about 85 a year. This in 2012, were those figures correct? About 85 a year?
Well, going on the figures that we gave earlier, Senator, of 66 in the year 2008, 2009, and 116 in the 2009-2010 year, that 85 figure is somewhere in the middle there, roughly.
Yeah. What about 10, 11, 11, 12?
I don't have the answers.
10, 11, yeah.
I don't have the answers to the later years. We're still working through that because, as I said before, we actually have to do a file-by-file review. So we have to open up each file to see whether a receiver was appointed. We don't have a record of that we can just pull up.
When CBA took over Bankwest 19th of December 2008, when you went to reviewing the loans in Bankwest, you said in 2012, and I quote, "The distinction that I'm drawing is that it was not a team of CBA people who were flowing in from the east to pour through the books. That was not the case at all. Was there a case where you had a lot of CBA officers actually went in and went through the books at Bankwest?
So Project Magellan that David referred to earlier did involve us bringing in additional people to help carry out that exercise, but the large number of the people involved in the exercise were Bankwest people.
But that was 18 months after.
That was in
acquisition.
2010.
Senator, are you referring to the pre-acquisition and at the 19th of December, or are you asking about 18 months?
I'm looking at just shortly after.
No, we didn't. We appointed a chief executive officer and a chief financial officer, but from CBA to run Bankwest, but by far the majority of the staff were Bankwest staff.
This is a tricky question. You did give us some information in confidence as far as the Ernst & Young report goes. Am I allowed to discuss that with you now? Would you prefer?
Yes, please do.
Okay, you clearly went in hard with those figures you gave us. You had provisions, impaired amounts where Ernst & Young disagreed with you, HBOS disagreed with you.
Yes.
You went in hard. Obviously, that was a reduction in the price of the bank if those harder claims you put would have been accepted. Is that correct?
These were loans...
I mean, I could look through them.
No, that's fine.
We know exactly what you mean, Senator,
Yeah.
I think. These were loans that existed and were impaired or troublesome
Yeah.
as at the date we took
For
ownership.
example, Rory O'Brien's.
Mr O'Brien,
You know,
exactly.
You claimed a figure of 46 million, I think, from memory.
46.05 million, that's correct.
HBOS said zero.
HBOS
Ernst & Young
and
said zero.
Ernst & Young said the loan is impaired in their report. They said the loan is impaired, but they said they didn't believe that a provision needed to be made, and so they didn't, and as a result the purchase price was not adjusted for that loan.
Yeah, it's very important to understand that this is why I tried to explain this stock take concept as at the 19th of December. What Ernst & Young did was say, what evidence is there on the books as at the 19th of December that you're going to lose money on this account?
Yeah, that's
so
right.
although in the case of Rory O'Brien, they said, although we recognise that this account is technically impaired, it is...
Was that because it hadn't been rolled over? Had it just expired?
No, I think
It had
they...
expired at that point.
So it expired in January?
It expired in January, it was extended
And
in November.
HBOS Bankwest had agreed to extend it to the 30th of April?
No, they agreed to extend it through until January, so January 09.
I thought, no, they
So to
I
answer...
think you'll find that the HBOS, Bankwest, not HBOS, owned by HBOS, whatever it was, I think they'd agreed to roll his loan over to the 30th of April and work through the process of selling off the
No, Senator.
the pre-sales, etc.
No, Senator. The Bankwest issued letters in December, 2 letters in December to Mr O'Brien. Those letters extended the facility until the end of January.
Well, can I just
Go,
jump in
yeah,
there?
please do,
Senator?
Chris.
Just referring to the Ernst & Young report at point 226 on page 21.
Yep.
It's noted there that the Bankwest had a workout strategy as of the 19th of December 2008, which included an extension of finance through to the 30th of April 2009.
That's right.
And it listed a number of aspects of that workout strategy. And I think they noted then that at 2.30 on page 22, that they were satisfied that the business case scenario identified would provide an acceptable assessment of the potential financial outcome, and
As at 19 December.
as at 19 December 2008. So that's, and 2.32, they say there's no specific provision required for this loan as at that particular point.
That's right.
So there was a workout strategy in place.
There was a workout strategy. They saw, so what they did was they saw and this is all part of these discussions that were ongoing backwards and forwards that we've referred to. They saw the proposals on the workout strategy and they said, based on the evidence that was present as at the 19th of December 2008, we can't be sure that you're going to lose money as at this point in time. Now,
HBOS said.
Sorry?
That was
Ernst & Young said.
Ernst & Young. So that was the final arbitration, so there was no price adjustment in respect of
That's right.
Rory O'Brien.
But there was an extension from Bankwest prior to takeover to go through to what Senator Ketter said, 30th April, is that correct?
Well, there were
Senator, no, according to our files, the extension went through only until 15th of January 2009.
So you're saying the Ernst & Young report is incorrect?
The Ernst & Young report refers to a strategy to work out. It doesn't refer to an extension of facilities. So formally speaking, the facility became due on the 15th of January 2009. The strategy that they are referring to was a proposal from Mr O'Brien, as I understand it, to try and work his way out of the difficulties, and that involved potential equity raising from the Middle East, a potential hotel operator, and the sale of apartments.
Well, this is not Mr O'Brien's strategy, this is Bankwest's workout strategy.
Well, in fact, it was a proposal from Mr O'Brien that was put to Bankwest for acceptance, ultimately was not accepted.
Well, Ernst & Young clearly say here, 2.26 under Ernst & Young, we note that Bankwest workout strategy as of 19th of December 2008 included an extension of finance through to 30th April 2009 to allow for full settlement of existing sales, finalise proposed purchase of the management agreement, establish an investment vehicle through Fortis to secure a minimum amount of funds, allow for completion of all works for infrastructure for a pre-opening schedule of March 2009. Complete all other sales currently in the pipeline. That's what they're saying, Ernst & Young.
That's right, Senator, but I don't think they're saying anywhere there that the loan did not expire until April 2009.
We note that the proposed workout strategy was described by Dransfield as potentially providing a very significant improvement to the project likely gross realisation and risk profile, enables the rate and real estate value to be positioned well above the level it might otherwise be through a lower quality domestically focused operator. Was there $106 million of pre-sales with that?
So we're aware of Mr.
Sorry, I realise, Mr Cohen, you've given us papers tonight when we first arrived. I haven't read them.
No, that's understandable. There's a lot of material. So Mr O'Brien, I believe, did claim that there was approximately $106 million worth of pre-sales.
Yep.
I'd like to set out for you the facts as we know them. There was not $106 million. We understand that there was the potential for $100.5 million of pre-sales.
The potential?
Yes, as we understand it, the maximum value of pre-sales was $100.5 million. I know it's a small discrepancy between 106 and 100.5, but I just wanted to make the point, as far as we know, it was a total potential of $100.5 million.
When you say potential, Mr Cohen, are you talking about the value of the property or pre-sales for which a deposit was held?
That's what I'd like to come to.
Good.
So, as we understand it, Mr O'Brien understood that contracts existed that totaled an aggregate purchase price of approximately 106. We understand it was actually more 100.5. Setting that aside for a second, of that 100.5, approximately $17 million worth of contracts were never exchanged. So these, we understand, were contracts that were in escrow but never signed and never exchanged between purchaser and seller. So those contracts didn't exist. So you take $17 million off the 100.5. There were a further $25 million worth of these contracts that were exchanged and were signed, but the single buyer of all $25 million worth was a company that was in receivership, and they were therefore unenforceable. So those were contracts that could not be followed through. The buyer was in receivership. Mm-hmm. Then there was a further $7.2 million worth of contracts that were signed and exchanged, but where the purchaser, from memory, was entitled to walk away because construction had not been completed by the timetable dates. Right. So that left approximately $50-odd million, about $57 million worth of contracts in place. And when eventually a receiver was appointed, the receiver was faced with those contracts, not the 106 as has been claimed.
Yeah, the reason I ask you is I've got an affidavit of Michael Gerard Allen from Mallisons, dated the 29th of November 2012. And in this he swears that as part of Mallison's engagement, Mallesons was required to prepare regular reports to Bankwest regarding such matters as to the identity and value of the apartment sold, the details of purchases, the deposits held, and any contract special conditions which differed from the financial approval per forma sale contract. Such a report showing pre-sales with a value of about $99.239 million as at 2008. The report is in the form prepared for Bankwest from time to time. To the best of my recollection, the amount of pre-sales ultimately exceeded $100 million.
Mm-hmm. I have no doubt that that's exactly what he understood at the time.
Yep. So you're saying 25 million was from a company that had gone belly up anyway?
Correct. And 17 million of sales were not exchanged contracts.
Right. You end up selling the whole block for 56 million, is that correct?
Yes, sold in one line, that's correct.
The building was complete, wasn't it?
No, it wasn't. So Mr O'Brien has given testimony to the effect that a certificate of practical completion was issued in November 2008. The certificate of practical completion that was issued under the building contract. That was a building contract to build residential apartments. Mr O'Brien wanted to develop a resort, and in order for the resort to be completed, a hotel reception had to be built, a much larger reception than the apartment reception. A gym had to be built, a spa and a restaurant had to be built, which required additional funding. So although Mr O'Brien has testified that the building was complete, it was not completed as a resort, it was not ready to be occupied. In addition, there were 54 pages of defects in the building, and the sewage was not operable. So the building was a long way from complete. It is true, and this may be what he was referring to. It is true that a certificate of practical completion under the building contract was issued by the builder, and that's a statement by the builder that he has built the apartments, in that case, according to the contract specifications. So that amount is absolutely true, but it was not complete as a resort.
Okay, but I point you again to the Ernst & Young report at 2.12a, which states that the practical completion of the Whisper Bay Resort at Airlie Beach occurred on the 28th of November 2008.
Correct, and that's what Ernst & Young was referring to, practical completion under the building contract, which was a building contract to build apartments. Now, he calls it the resort because that's exactly what Mr O'Brien called it. So that makes perfect sense. So there is unfortunately, the situation here is that there is a misunderstanding as to what was intended to be built and what was actually built. What was actually built were residential apartments, not a resort. There were plans to build.
So you loaned money to Mr O'Brien to build apartments. He sold not 106 million, but 100.5, 17 million weren't exchanged, 25 million were not be able to sold because of receivership, 7.2. He finished them too late to get the money, but that did leave $52 million worth of apartments.
Correct.
That were complete, which could have been sold as apartments.
Yeah, I think it's worth just sitting back.
Yeah, that's why I'm just clarifying. Is
Right.
that correct? Those $52 million worth of monies that were exchanged, properly exchanged contracts, were for apartments.
They were for
units resort.
in a
Units
resort.
in a resort, unfortunately, and that led to.
So he'd sold for resorts,
And he didn't deliver.
And unfortunately, what happened.
not for apartments.
No, so what happened was when it seems that, from what we can tell, it seems that the intention behind the development changed along the way. And it seems that along the way, contracts for sale of units/apartments were sold on the basis that they would be part of a resort. And representations, it appears, were made to the buyers that the resort would include a restaurant, a spa. It would be a 5-star.
Did
quality
Bankwest
resort.
agree to finance that resort, etc.? They had agreed to that, hadn't they?
Bankwest had been informed by Mr O'Brien at some stage along the way of his change of intention for the development, yes.
They had agreed to it?
And Bankwest
proposal?
continued to fund. Bankwest continued to fund, that is correct.
So it agreed to his proposal? Yeah.
So to come back to Senator O'Neill's question, these contracts were entered into with people on the basis of representations that the development would contain those sorts of facilities befitting a 5-star resort.
Written into the contract?
As I understand it, they were representations that were made and that were part of the expectation in the contract.
You can provide the evidence that they were part of.
We'd be able to get contract.
Well, I mean, truth is we couldn't. We tried to complete these pre-sales.
I mean, essentially
and
the
they
argument
couldn't be
is
completed.
that you had apartments under contract of sale that was only part of the project, and you could have realised that, and that was as much as you got by selling the whole.
Yes, that's the
That's the
allegation.
argument.
I understand that, Mr. Ruddock.
And it seems to us that, you didn't complete the contracts that were there. Now, you're saying, well, the contracts are not, or the contracts were to sell something that is different
That's
to what the building, the stage in which the building had been completed.
Yeah,
that's
Now,
correct.
that's a question of fact. I don't know where the truth lies, and you're asserting it, and I think you need to demonstrate with the contracts that what you say is true. Because, I mean, at the end of the day, this is public evidence, and it's going to be out there for others to comment on, and presumably if Mr O'Brien has a different view, he will tell us that.
Yeah. I think before we go into the detail, it's just worth pausing and thinking about what was this resort. So at Airlie Beach, the highest prices that had been paid for
I saw
apartments
that. I saw that in your argument.
was about $1 million prior to this resort
So
coming
we'd
along.
never develop a five-star resort.
And the plan was to develop a 5-star resort with restaurants and so on that were going to be $2 million each. The GFC comes along and suddenly no one wants $2 million apartments. In the end, and through a proper marketing process, it was deemed that the best way to sell these things was in a line, and they were sold for $538,000 each. There is a company there trying to sell these same apartments today, and since then, so these are supposedly finished in 2008. As of today, only 24 out of 104 of these apartments have been sold, and they're selling at about $730,000 each.
Was the
So-
resort ever finished, though?
Sorry?
Was the resort ever finished? in terms
Not the
of
resort.
restaurant?
They're selling them as apartments, But they were what was finished was all of the defects that were on their property.
Okay. But that argument is like saying that we promised somebody a Lamborghini and they agreed to pay $200 million.
Yeah.
And in the end, we delivered them. Better be careful what car I pick here, or I'll offend some. But,
Yeah.
delivered them a Ford Falcon, and we were surprised because we only got $50 million, $50,000. Sorry. So what was promised was a resort. And the argument would be if he had been allowed to finish the resort, a 5-star resort, then he could well have achieved the kind of figures he was looking for.
Well, I think we're forgetting the GFC. And I think that the current owner, if it was viable as a resort, the current owner would hardly be selling them for $730,000 each if he thought he could sell them for $2 million by just turning it into a resort.
Mr Craig, it's not completed. The GFC, let's face it, we're lucky in Australia we didn't actually go into recession. We recovered pretty well on the
GFC the same as everybody else.
Sorry?
I mean, even in your own submissions, you say we didn't suffer the GFC the same as everybody else.
No, it's got a big debt now.
Did
Probably
they
a
look at
political
comparable sales?
agriculture savings.
And what was, so, I mean,
Chair, I've
it
got a
seems
couple of
obscure to
questions.
me that anyone thinks they get $2 million for a unit, wherever the hell this was.
Exactly.
But in the comparable sales department, was there any of these resort-style developments around, or if not serviced apartments, you could fall back, the valuer could fall back on?
As we understand it, Mr Lawney, part of the issue was that there were a range of apartments coming online within the region at the same time, so there was competition. Secondly, that they were priced well above the then market for the area. And thirdly, and to come back to, I think, to Mr Ruddock's point earlier, although there was $50-odd million of contracts on foot, the receiver determined that actually most of those contracts were at some risk, so $23 million worth of the remaining 57-odd were at risk because of the representations that had been made about the quality of the resort and the quality of the apartments, and the buyers were entitled to avoid the contract because of what was promised and versus what was being delivered. Secondly, there's about $14 million worth of those contracts were able to be terminated because of failure to meet the building deadline. And so the receiver determined that actually it was not feasible to proceed with those contracts.
Senator Williams, back to you.
Yeah,
till
thanks.
25
Okay,
past.
so the point I made, Mr Cohen, is when it came to assessing these loans and disputes, which you end up paying extra $26 million, you went in hard, didn't you?
In respect of the...
I'll quote some, $46 million on Early Beach. Ernst & Young said 0. Let me just flick through a few more. 18.98 million on Fitzroy Island, Ernst & Young said 6.4. We even had some here where you went in to claim money back off if we can call it the settlement of the stock of the shop. Mr Craig, as you gave a good analogy earlier on. Some HBOS A and Ernst & Young said they were not impaired. Here's one, Pringle Group, HBOS A not impaired, Ernst & Young not impaired. You said it was impaired for $7.62 million. So going on those, you went in pretty hard, obviously.
We had a more conservative view than HBOS did, yes.
And your more conservative view would have led to not paying as much for the bank.
So on those loans...
For the stock of the bank.
On those loans,
Yeah.
we took a view that actually the capital that had to be set aside as a provision was greater than HBOS's view of that capital.
Yeah, but
and
the point I
therefore-
make is that your more conservative view would have meant that if you'd had it your way, you wouldn't have paid them another 26 million. You would have probably got another couple $100 million off the bank.
Well, there were
Off the
ups and
stock of
downs,
the
as you know. There were ups and downs. On the loan provisions alone, if you just took those alone, we took a more conservative view and we would have been seeking a greater reduction on the price than
That's what I
Ernst &
mean.
Young
What
failed.
you request with Ernst & Young, you sought a bigger reduction on the price because you went harder on the assessment of your loans.
Well, Senator, you could say that we went hard, yes. Equally, you could say that in the aftermath, once we became the owner, the view that we took was actually the right view as it turned out in relation to those loans. Unfortunately, that's not something we're proud to say, by the way. But unfortunately, our view at the time of looking at the provisions was the more correct view in reality as the years rolled by in the future.
And Mr Craig, were loans buried, if I can use that word, to meet APRA and Basel II advanced accreditation requirements? Well, did you have a problem with capital requirements, Basel II, you lifting the standard of the bank, etc., under Basel II requirements and APRA? In Bankwest, when you took control of it?
Bankwest was under Basel II standardised capital treatment. Commonwealth Bank was under Basel II advanced capital treatment. So under Basel II standard capitalised treatment, you carry a bit more capital for normal loans, but you don't wear as much of a hit if loans become impaired as you do under the advanced accreditation. There's a slight difference in treatment, but that has no bearing on, I don't think, on this discussion.
You asked that question because Bernie Armistead, it says on his LinkedIn, Workstream Lead Bankwest, 2010 to 2012. One of his jobs, extension of advanced Basel II accreditation resulting in significant capital savings for the bank.
Right. So exactly right. So we worked with APRA. APRA required us, of course, to move Bankwest onto advanced accreditation because it's a more sophisticated measure.
Yeah.
And we worked hard from 2008 through to 2012 with APRA to attain that advanced accreditation, which we got in 2012, and it sounds like that might have been one of the gentlemen who helped us to do that piece of work.
Yeah, so the reason I ask is, was that a reason why you were severe on some of your customers? Because we've heard the committee's had some terrible evidence. I mean, Colin Powell, the bloke with the pub, valued at 4 million, then 3.5 million, and then he tells the committee the valuer bought the pub for 1.7 million, was still doing better figures when he bought it at 2.5 million, and the bloke was just destroyed. Done his marriage, done everything else.
Yes, so Senator, to answer your question, did the way in which loans were managed going forward have anything to do with Basel II and whether or not Bankwest achieved advanced accreditation? The answer is no.
Yeah. Well, the point is, because under the Banking Code of Conduct, Mr Cohen, and you are signatories that the Banking Code of Conduct, we will act fairly and reasonably towards you in a consistent and ethical manner. In doing so, we will consider your conduct, our conduct, in a contract between us. You're also saying that banking code of conduct. With your agreement and cooperation, we will try to help you overcome your financial difficulties with any credit facility you have with us.
Yes.
Now, the evidence we got from Mr. Powell, that was clearly not the case.
Well, Senator, I've read Mr. Power's evidence and I've looked at the documents surrounding Mr. Power's loan, and I understand from his evidence that he has given you that you could have the impression that the bank acted in a high-handed way. The review of the documents from my point of view shows that actually there was consideration given to assisting Mr. Power. Now, Mr. Power has put forward, I admit, quite compelling evidence to you that he went through a very difficult
Mr. Carver,
time.
just to interrupt you, one of my concerns is section 420A.
Yes.
Because it's just a process, it's a toothless tiger, house you can't act on it or whatever. And I think Queensland, the state of Queensland has far more severe 420A legislation. When you have a hotel valued at, well, let's be kind, bring it down to 2.9 million. It's sold for 1.7, doing 40 or 45,000. Mr. Laundy would know exactly what it's worth over there, the publican on the committee here. Yeah, these assets being sold, I met with people yesterday, and bear with me please, Chair. They had 4 properties they sold to. This was Bankwest back in the middle of 2007, before you were anywhere near the scene. They've put a submission here. The last 2 properties, Elizabeth Beach, are valued at 875,000 each, so 1.7 million. They sent the values in, they valued them down about 375,000. The bank manager was panicking at Bankwest. Nothing to do with you. I said you hadn't come on the scene. The bank manager went to the real estate agent in a panic. Next day, the bank manager sold both properties for 375,000. I wouldn't be surprised if the bank manager actually set up the loan for the buyer, who put them on the market for 1.1 million each 12 months later. You can't have assets worth $1.7 million valued and then sold for about 650,000. Of course, it bankrupted the owners, destroyed them. If they'd sold them at their market value, they'd have walked away debt-free and gone on with their lives. It's destroyed them, broken the family up, etc. I just failed and said, I'm going to chase it up how you could ever sell something that's assets nothing to do with Commonwealth Bank. This was mid-2007. And I think it's a disgraceful situation where I wouldn't be surprised if the bank managers under stress from, could be HBOS in the UK when they're in trouble, could just fire sell.
Sorry, at the moment it's becoming commentary. I'm going to go to Senator Ketter.
Oh, it's good commentary though, Chair, wasn't it?
I'm sure it's very compelling. Senator Ketter, you have
I was enjoying it, but I do have a couple of questions. And coming back to Mr. O'Brien.
Yes.
And in his submission, Mr. O'Brien talks about the fact that, and I'm coming back to this critical period, the beginning of 2009, and noticed your comment just before that you're wanting to assist your customers to assist them through any difficulties, but well, Mr. O'Brien had reached a critical point at the beginning of 2009. We've acknowledged already that there was a workout strategy that Bankwest had as at the 19th of December 2008, which on the evidence of the Ernst & Young report suggests that there was finance through to the 30th of April 2009, and with a range of activities there. But Mr. O'Brien says in his statement that during this period, CBA Bankwest became slow to pay us and our consultants, despite the signed agreements and undertakings. And Senator Williams has already referred to the statement of Mr. Allen, who and where Malison's attempts on our behalf, these are Mr. O'Brien's words, to undertake the crucial initiatives to register the strata plan and settle the pre-sales to dramatically reduce our debt were frustrated and deliberately delayed by lack of timely decisions, information and instructions from CBA Bankwest. What's your response to that?
Well, first of all, as I mentioned a little earlier, the 2 lenders were Bankwest and Bank of Scotland International. Those 2 lenders worked together and they each had to come to their decisions and reach a joint decision in order for anything to happen. So that naturally does slow things down. I can't attest today as to what level of delay there was, but the fact that there were 2 lenders involved, one of which was completely independent of CBA, does mean that they went through their own processes, as did Bankwest.
Well, what efforts did you make to expedite things, because as we can see, this was a critical point for the project.
CBA was not actively and directly involved with Mr. O'Brien, as he has said in his evidence, and he's correct in saying that. He was dealing with Bankwest and Bank of Scotland International. So in terms of what efforts Bankwest made, I can't speak for Bank of Scotland International, of course, but in terms of what efforts Bankwest made, as we've alluded to and as Mr. Ruddock has asked us to produce, there was a lot of discussion between Mr. O'Brien and the two lenders in the period from January through until April. That discussion was largely around a plan that Mr. O'Brien had proposed, and as I think I've mentioned to you, that plan involved hopefully introducing new equity into the project from the Middle East, introducing ESC as a hotel operator to the project, and also involved receiving more money from the lenders in order to fit out the resort to resort standard, i.e. by building the restaurant, the spa, the gym and the bigger reception area. So those discussions were happening in that period. As I understand it from looking at the documents, there was serious consideration given to that plan, but in the end, due to a number of reasons, partly to do with the contracts, partly to do with the state of the building, partly to do with the state of the hotel management arrangement that was actually never entered into as a binding document, partly because there was no further equity that appeared on the scene. In the end, the banks, the two financiers, decided not to accept Mr. O'Brien's plan.
Is it true you gave Mr. O'Brien 48 hours notice to repay $178 million?
So that was the claim that Mr. O'Brien has made. What he doesn't mention is all of the lead up to the final notice. What he's referring to is the final notice. This was a period where he had, whether his loan facility, his loan had expired in January 2009. So he was well aware of that, and obviously all the discussions were about trying to continue.
Yes, and surely that would have been in your interest to sort something out at that point.
The intent, as I've said before, is to try and work something out if it is feasible. In the end, the two banks, Bossie and Bankwest, decided actually the plan was not feasible and that the risks of continuing were greater than appointing a receiver.
But is it true that you gave him 48 hours notice to repay $178 million?
The final, I'll tell you in just a second. A letter was issued to him on, sorry, just bear with me for a second. I think it was
that, Mr. Cohen, I just want to advise.
It was the 6th of April 2009.
Just hang on. I just want to advise the committee, yourselves as witnesses, that we are going to extend until 10 o'clock this evening. Senator Ketter, we have a number of other questions to get through, so one more question, please, and we'll go to Mr. Miles.
Thank you.
So the letter was issued on the 6th of April 2009, and time was given until eventually the appointment of the receiver was made on the 20th of April 2009.
So two weeks.
So 2 weeks before the appointment of the receiver. Now, I think it was the final demand letter that actually said that he needed to repay. And whilst the 48 hours sounds draconian, I think it's very important to remember that this is actually the very final step. This is not a letter out of the blue. This is a step over 4 months of discussions talking about the fact that the facility had expired, that interest was now becoming overdue, that the development was not complete.
These were the discussions I asked to
Yes.
document.
Correct.
Look, Chair, I just have one more question. I just need to raise another submitter, Mr. Butler, who is submission, I think it's 113. Mr. Butler has provided me with, he's concerned about receiving a copy of a internal report which...
Senator Ketter, can I ask you not to proceed with that?
Beg your pardon?
Can I ask you not to proceed with that?
Okay, yeah.
Thank you. Mr. Miles.
Mr. Cohen and Mr. Craig, just want to go back to first principles here. Earlier in the evening, you said that the government of the day had not requested that you go in and rescue Bankwest, that it was a commercial decision.
Yes.
And that you'd been looking at it from around September, October, discussions following through, give or take a little bit. We chose to speak about this earlier at a different venue, and I said, so when you made the decision, how much due diligence did you do? And you said possibly 3 days.
Yes.
So I'd like to confirm that. That's a very limited time for due diligence on such a huge purchase. And in the deed of contract of sale, there's actually quite a number of sections that say that the accounts and the records have to be, the books, ledgers, financial records of each group companies have to be properly maintained and don't contain any or reflect any problems with the system. So presumably, when you took over Bankwest, it wasn't in too bad of a state, because that would have been a commercial decision.
So if what you're asking, Mr. Demalis, is when we took over Bankwest, was it in a good condition? And the answer is it was in the condition that we expected it to be in, having done the due diligence and then having had the period between when we signed the contract in early October 2008 through to completion on 19th of December 2008. We also had the opportunity to learn more about the operations of Bankwest. We weren't running it, of course,
Yep.
but naturally we were learning more about it as we went. So it was in the condition that we expected it to be, largely. We did have some anticipation that the commercial loan portfolio was not going to be in great condition.
And that brings me to the question of, if it was in reasonable condition, as seems to have been indicated by a couple of the independent reports of the day, what prompted you to do the accounting exercise that then took place?
Oh, okay, sorry, the one, Project Magellan or, well, as I explained, so Project, sorry?
Were there others in addition to Project
Well,
Magellan?
obviously there was the exercise that was done as at the acquisition date, and I was just checking whether it was the one at the acquisition date or Project Magellan that you were referring to.
I'm happy to have an answer to both of those,
Okay,
thanks.
so as at acquisition date, as with any business, and I tried to give the example of buying any small business, you count the stock and you value each item of stock. That was the exercise that was done by, as it happens, by 3 sets of chartered accountants, KPMG for HBOS, PwC for us, and then Ernst & Young as the independent expert. The fact that the 3 of them came up with 3 slightly different answers is a pretty good indication that there's an element of subjectivity in valuation of stock. Further on, as I explained, about 18 months later, what we were discovering was that we were in the centre, in Sydney, we were hearing of problems later than we should have been. Accounts that should have been on watch lists and we should have been aware that there was a potential problem were going straight through that stage to near collapse, and so we felt it was critical that we reviewed a good chunk of the files. The other thing that was happening, of course, was property valuations were falling. And so the 2 things caused us to say we need to do a thorough review of a good sample of this book to make sure that all of the individual loan accounts are up to date and shipshape.
That causes another set of questions, actually, that if you then had the properties revalued in relationship to falling property values, was that because they were not paying their loans, or was it because you then had to just review the values of the properties on your books? And if that was the case, then that's difficult. And I'd like to, this could be the chicken or the egg question, which came first, the process of looking at those loans? Was it because there were difficulties coming through, or because that there then became difficulties coming through because facilities weren't being rolled over because of the communication gaps?
No, it was purely an accounting exercise to get firstly to meet our prudential obligations, to have these files completely current and up to date, and obviously from an accounting evaluation point of view to ensure that we were on top of the current value of those accounts. As far as loan valuations are concerned, 2 things were happening. We have an obligation with most loans, where they're to do with property and property development, to have a valuation done every 3 years, so that we're, again, current. Is a bit like having an annual health check for yourself. So when your security is property, then you want to make, and property prices are moving about, then you want to have fairly regular valuations to make sure you know the health of the client. So we would have looked at valuations that were due for renewal and had them done at that point in time. Most of the reviews, though, were really file reviews, and we got in, and I think we talked a little earlier about a range of independent experts that came in who were specialists in the different fields. So, for example, we had a look at aged care, we had a look at hotels, we had a look at property. They were sectors that were having trouble at that time of the cycle, and we got specialist firms in who were specialists in those areas to look at the files to make sure that our staff were, on top of the files.
But, Mr. Craig, forgive me for interrupting, but it sounds a bit odd that you choose a time of economic depression time, like we'll change values, that if there isn't an existing problem with the loans, why you would choose to have a revaluation at that stage, which in some cases automatically triggered a problem. Why would a bank choose to do that?
Well, I want to come back to the statement I made in my opening sentence, which is...
No, that's it. I'm
property
not gonna give an answer.
valuations. We know of no circumstances where a change in property valuation alone has been the cause of us defaulting on an account. Okay, so yes, from an accounting and valuation point of view, we need to make sure that we're aware of what's going on. But if a customer is paying their interest and in current form, then that's usually fine. But we still need to be aware that if they do have a problem subsequently, that we may not have the security to back it up that we thought we had.
Okay, Mr. Ruddock. Cool.
That's not how it went.
Look, I do appreciate the amount of work you've done in preparation for these hearings. I've been reading most of the material during the course of the afternoon, sitting through question time. I'm doing it in a couple of hours. You've spent weeks, perhaps months, preparing it. I imagine there will be others whose evidence you are contesting who may want to offer further advice. We're not going to be able to deal with these issues this evening, even with the extension for another 20 minutes. And I wonder whether there is another strategy. I mean, we can have some experts go through all the evidence, assess it, weigh it up, and we can offer a view. We could call for a royal commission, say these issues ought to be examined. I wonder whether there is another potential strategy that you might like to consider. You tell us that there are a relatively few number of commercial loans involved. I mean, we're talking about potentially somewhere between 1 and 200. There are people who have settled claims, I understand, without us being able to know of the terms on which they've been settled. There are others who tell us they have had legal advice which enables them to potentially bring legal proceedings to recover a remedy, but because they've been, in some cases, bankrupted, or if not bankrupted, left destitute, they are not in a position to bring those proceedings. And I wonder whether there might be a fallback strategy for the bank to look at all of these issues afresh and to agree to a form of mediation by agreed and independent arbiters to see whether these people were dealt with fairly.
Senator, if you're asking would we consider that, we'd like to understand the universe that you're talking about here.
Well, we've come to a point where we're saying there are a relatively small number of commercially impaired loans, and I'd like to see them dealt with.
So there are...
and there are a variety of ways that we can deal with it. To try and establish, I mean, we've had the evidence, we've got your submission, we're going to have further commentary on that, and I'm saying to myself, how do we deal with it? I'm not going to be able to find the time to go through every submission and deal with the issues. My view is we would have to have a comprehensive investigation by somebody who is competent to do it in relation to all of those matters to test the evidence. And I'm also saying, you know, there are people who would have taken these matters to court if they hadn't been left totally destitute. I'm saying there needs to be a way forward. One way that's being suggested is that we should recommend that there be a royal commission to look at all of these matters afresh. And I'm saying, as a fallback strategy, are you prepared to take a positive step yourselves to deal with these issues? I mean, look, what we're being told is that banks don't want to see people in these situations. We want to work these things through. We want to do it constructively. And I'm looking at people who come to me when they say, we are right at the end of the door, we believe we've got a remedy, we've got legal advice that says that there are claims that we can bring, and we are now destitute and can't do it. So how are we going to find a way through this? There are ways I've suggested, and they have significant implications. And there may be a fallback strategy in which you could agree we're going to have all these matters looked at again. There'll be an independent agreed mediators that will be appointed, and we'll go through it with the parties genuinely to try and resolve it and to try and put matters back if you can. That's all I'm suggesting.
I understand, Senator. Well, the first point I'd make is we gave some figures a little earlier, referred to our 10 November letter. There are about 2,000, a little short of 2,000, commercial loans where we incurred losses between when we owned Bankwest and the 30th of June 2015. So there's a rough order.
Sorry, it's gone to 2,000 now.
No, I told you before, it was 1,958. That's the figure we talked about before. So that's the rough order of loans where losses were incurred. Now, that doesn't mean, of course, that every single one of those loans might be in the sort of situation that you've described, but at least those were loans where losses were incurred.
We're at it again. Now, there are the 1,900 possibly impaired, but which you're still...
No, I'm sorry. No, I'm talking very specifically about loans where the bank suffered a loss as a result of the loan not performing and assets being sold.
Okay, where people have been sold up.
Yes.
1,900.
So about 1,900, just over that.
Yeah,
Just
all right,
over.
well, that's I was writing the figures down to about 200. I thought it was... from what you were telling us before, 66 here and 85 there, and
So those
it's not a big problem at all.
Those are the number of receiverships for 2 years that I gave you. And the number that I've given you, because the committee asked for it, was the losses that were incurred between the period December 08 to June 2015.
I was much happier that it was a small, marginal problem we could work our way through rather than this.
That goes towards that as well. So the point of raising that simply is that to come up with a method that works, I think we need to be able to consider how to deal with large numbers of people, is the first point. The second point I'd make is that we have, as an organisation, we have said to people, if there is something here that we have done wrong and where you can show us where we have done wrong, and let's...
Yeah, well, I don't like the term wrong. I mean, I imagine what you're saying is something that you can strictly find was unlawful under contracts that were written with particular provisions that I now think are inappropriate.
Well, actually,
and for consumer protection reasons, I would like to see addressed even in commercial loans.
I'd go one step further though, Mr Ruddock. I'd say not only the terms of the contract, but also the way in which, taking into account all the circumstances, the way in which the bank dealt with the customer. So that would include, for example...
being a wider set of factors.
Concessions given, demands made, all of the factors that go into it. So what I would say is that we have always said that if there are circumstances where somebody genuinely believes and can present us with evidence, we have said a number of things. One, we're prepared to look for it, at it very closely. Secondly, we've actually said this through our CEO to one of the Bankwest customers who was very much bringing these issues to the fore, that we are open to people bringing us those circumstances. Now, what I will say is that it is a fact of life, unfortunately, and this is very personal to customers, it is a fact of life that when a business or a venture fails, when it doesn't succeed as initially planned, and if a bank does take action and pursues a sale of the asset, it is very traumatic for the individual. It is very emotional for the individual. We well understand that. Our team that deals with the workout of loans is very, very conscious of that. And there is no doubt that even when we do things properly, even when we do things taking into account the interests of the customer as much as we can, many customers are still unhappy with the result. They are still unhappy with the outcome. That is a natural human response, and we do understand that. I do think that some of the cases that we're talking about involve that very normal response, human response. And I would, from our point of view, if it was to prolong...
Well, perhaps if you take it on notice, because I suspect the way in which you've dealt with it encourages me to look at what more robust approach we should take.
Okay, thank you, Mr. Ruddock. We will finish off, like your opening statement, looking at some of the ways forward potentially, but also just to understand some of the drivers in your industry. Mr. Narev, on a few occasions, has talked about revenue on cost targets from everything from individual branches, right through to the whole corporation and your profit targets. Can you tell me what were the targets for revenue increase this last year? Is that something you can provide for the committee over 3 or 4 years?
We don't have revenue targets for the group or for any particular business. Obviously, like any business, our individual businesses have budgets.
So on what basis do you go to the market with a profit target?
Sorry, on what basis do we...
On what basis do you go to the market with a profit target?
We don't go to the profit. We do not provide any targets or any forecasts to the market at all.
Every financial report I read about reporting era talks about Commonwealth Bank is back on track to meet their targets.
Well, that's the analyst's target. It's certainly not ours. I can
so
assure
you're
you
telling
as the
me
Chief
that you
Financial
have...
Officer, I never provide any targets to the
so
market.
forget the corporation, come down to the bank the part of the bank that makes commercial loans. Do they have a revenue target?
They don't have a revenue target. They would have a budget that they're striving to achieve, like any business does.
Okay, so budget has credit and debit, so you end up having costs and income. So you have targets for what you're trying for them to bring into the business, to add value to the business.
Well, it's basically, yes. I mean, it's their estimate of what credit growth will be in the market. I mean, at the end of the day, we are just a provider to the demands of the market. And so the main driver of the budget for, say, the business bank is, the first driver is what do they think credit growth will be? And do they think they'll be able to grow at roughly the rate of credit growth with the strategy they have or not? And that's fundamentally the way the budget is prepared.
So the evidence that we get from people who say that there are incentives provided or targets set to write loans, for example, what drives the bank to put those incentives in place for people to write loans and generate business?
In commercial lending?
Did you ask what are the remuneration incentives effectively?
Either remuneration for the individual, but clearly if you're going to remunerate an individual, then there must be some target, there must be some goal that the bank is striving towards.
Not necessarily.
In Bankwest, you said they were aggressively seeking to expand market share.
Apparently.
That was clearly their goal.
Yeah, that's not, we don't do that. So all of our people are remunerated, all of our senior people are remunerated on a balanced scorecard, where customer satisfaction is the number one part of the scorecard.
Okay,
and then
I understand
staff
that,
engagement. So there's a range of
I've seen that
metrics.
in things that you're writing. What I'm trying to understand is, what are the things that motivate the behaviours of your executive and the people who are managing the credit business?
Seeing satisfied and excited customers wanting to do business with us.
That is very noble. 1 minute, please, Senator Williams. Yes, off you go. You've got 1 minute.
Mr. Craig, surely your bank managers out there in the country town, etc., they've set targets each month to meet on lending. I've been told about them 1,000 times where the monthly targets that the loans officer's got to meet targets. You walk in to put some money in the bank and the girl behind the counter says, how's your credit card? Do you want to raise your limit? I mean, aren't those staff set on targets each month?
So I think what you're referring to, Senator, are retail, in particular, in the retail branches, for example.
Yes, exactly. Yeah.
There are targets within the retail branch. Yes, there are.
Exactly.
I think Senator Fawcett was asking about commercial loans. And
I am.
the areas that make credit decisions around commercial loans, for example.
So can you just give me a feel then, business lending, the profit margin you make on business lending, how does that compare with other sectors of banking? I'm led to believe it's lower.
It is lower.
Okay. So do you report the turnover or fees generated by your credit management and turnaround functions?
Not publicly, no, we don't.
But you have them internally?
We do, yes.
Okay. When you look at a business to decide whether or not it should come from the relationship manager back into that credit management area, do you look at the level of distress or do you look at the potential value of the business or both?
When you say the level of distress, Senator, you mean the distress the business is undergoing at that time?
Correct.
Yes, we do. Both.
Does that make any difference, that difference between level of distress and asset value, in terms of whether or not you will actually work with the customer and seek to work out the distressed loan?
The first stance is always to try to work out the distressed loan.
Yes, we've heard that many times.
So,
what I'm
yeah.
asking is, as you do that evaluation, so you have two businesses performing about the same, one has lots of assets. Does it make a difference in terms of your decision whether to work out or to call in receivers?
Oh, I see. As I understand it, Senator, the way it works is in assessing whether a workout is feasible, we're looking at the prospects for the business, not how many assets are sitting there. The assets that sit there obviously are the bank's security, and they are the ultimate fallback if everything else does not work. But the assessment as to whether a strategy can be developed to enable the business to return to become a performing loan rather than a non-performing loan is based on the prospects of the business and what steps can be taken in order to improve the business or get it out of the trouble that it is in.
Can you describe to me what you understand by extend and amend?
I'm not too sure, Senator, what that is referring to.
It's been put to me that your credit management and turnaround section looks to extend a facility and amend the terms of that facility.
Oh, I understand. Sorry. That is sometimes the outcome of a workout, yes. So, for example, and I think you might have heard from some customers who have talked about the fact that their facilities were extended. And sometimes that workout involves amending the existing terms of the facility. And if I can give you an example of one, not by name, but for example, a customer whose business is struggling or is having some financial difficulty may be extended further time in order to repay, but also may be the strategy may involve selling some assets. And so what will be written into the amended agreement will be a timetable for the sale of the assets and the payment of the proceeds of sale to the bank as part of the way of working the loan back into health.
So we've had a number of witnesses who've described the amend process and indicated that they've been required to make additional guarantees. So in some cases it's been extended family or personal homes or other elements as part of the amend process. If you did that, would it not appear conscionable that you should then also give a minimum period, if you were prepared to actually call someone to put their home on the line, that there would be a minimum period before you would actually start taking action and calling in receivers?
Well, in the case of a home, Senators, you'll probably know there are minimum periods already built into legislation around the country before action can be taken against the home in any event. But I think if, in the circumstance you've described, which is, I think, if additional security is being taken and that additional security is the business owner's residential home, should there be some sort of minimum period built in? I guess minimum periods generally, and as we said in our opening comments, we can see some sense in there being some timing built into a period between when a customer defaults and when a bank requires repayment, for example. We think that as a policy idea that's worthwhile exploring.
I'm glad to hear you think it's worthwhile exploring. I do challenge 1 month. I think 1 month for somebody else to go and find another financier when they're distressed is far too short, and I doubt that you could look me in the eye and say that you would lend to somebody in a month.
No, Senator, when we say a month, we're not saying we give you notice and in a month's time you have to pay us back. What we're saying is we give you notice and then there has to be at least a period, and we're saying a month. A minimum month, before which the next step of the process can proceed.
Can I just say there, in your opening statement, you've got a minimum of 1 month between when a customer defaults on a loan and when a bank requires full repayment of the loan as a result of the default. That's not the next part of the process. It's give us the money back.
So that's when the bank issues a notice and says we want payment back. But our point here is that when issuing that notice saying it is time to repay, then we have to give time, obviously, to repay. So what we're saying is there needs to be a month at least before step one, which is default, step two, which is delivery of a notice. And then in that notice, banks, as a normal practice, give time. Now, I know you have heard testimony from people saying the time is too short.
Well, what is the time standard, Mr. Cohen?
There is no standard because it depends so much on the circumstances with commercial loans.
So we've heard the banks should act really quickly at that point because otherwise they could get nothing. So we've heard 24 hours, we've heard 48 hours, we've heard 72 hours. There's no code of practice that...
No, there isn't.
There's no requirement there.
There is no code of practice at the moment, you're correct.
And
So what
can you understand why that would be of concern to people who might be excitedly planning around their kitchen table about the business that they're about to start and seeking a commercial loan to find out that, you know, all of a sudden they could be required to provide a bank with money within 40
This is when they've
hours.
defaulted. So this is after they've failed to pay something that they're due to pay, for example.
And you know, some small businesses, it's pretty close. They might default, you know, they might default.
And the evidence is when we work through with you these 36 accounts, for example, that you've had submissions on, you'll find that in all cases we've granted way more than a month in every single case. In most cases, more than a year's worth of work with them. We try desperately to work things through. All of my suggestion there was because I'd heard around this table, you know, some concerns around very short periods, and we wanted to say we would agree with you. It shouldn't be very short periods, and at a minimum,
thanks, Mr. Craig.
should be a
We've
month.
heard that. Very conscious of time. In my reading on this topic, as well as extend and amend, I've come across the term extend and pretend. You familiar with that term?
No, I'm not.
Never heard of it.
It describes a practice whereby the lender knows that the business is not going to survive, but extends and pretends because it realises that there is a potential benefit down the track in terms of the asset value of acquiring those assets.
Senator, what's the supposed benefit to the bank?
Getting your hands on the house
There's
for security.
a number of reports, one to the UK government and their parliament, it's available on their website, describes it in some detail. Their two main banks, after an extensive report, it became very clear that that was a motivating factor.
I think you're referring to one of those as RBS, I believe. I am familiar with that report, and that was business loans in particular.
Correct.
From our point of view, we cannot see the commercial advantage to the bank in extending the pain that a customer is already going through in a commercial loan. It does not serve our purpose.
Okay, can I just ask, with the legal firms that you engage, do you have non-compete clauses?
In terms of what those law firms can do?
So those firms can't work. If you have a client who feels though the wrong thing is done by them and they want to go to a quality law firm, that firm also works for you. Do you have a non-compete clause so that that firm can't work for the client?
We have a clause in our arrangement with those firms that says those firms cannot litigate against us. They can act in commercial matters against us and they can act in non-litigious or non-dispute style matters, but we don't allow those firms to litigate against us.
Sure. Would you be able to take on notice, and perhaps over the last 2-year period, let's limit it down, how many disputes you've had that have started out with a legal process and how many have actually gone to court and how many have been settled out of court?
In respect of commercial loans?
Yes.
Or generally?
No, commercial loans.
Commercial loans, sure. Yes.
And we'll come back with some more questions once we see that. And what I'd like to know is, for each of those, how long was that process?
Sure. Yep.
Particularly if there's a difference between those that went to court and those that you settled
Yes.
out of court. Now, the time being after 10 o'clock, we are going to have to call it to a close there. You will get a number of questions on notice. You probably can expect that we'd like to speak to you again early in the new year, particularly as we look to moving forward in terms of shaping an environment to protect small business into the future. Can I say thank you for attending today's hearing?
Yes.
We appreciate it. We do appreciate genuinely the work you've put in and your staff to preparing a lot of documentation. We will take some time to absorb the things that you provided today. Clearly we haven't been able to do justice to that, and that will probably form the basis of some of the additional questions that we have. Could I have somebody move that we receive the documents that have been
I'll move that
tabled?
way, Chair.
Thank you. Can I say thank you particularly to Broadcast and Hansard, who stayed back late, and the committee is now adjourned.
Thank you.
Thank you.